Companies say bringing workers back to the office is about culture, collaboration, and productivity. But when you step back and look at the incentives, a different institutional story appears. The push to return to office is not just a management philosophy. It is deeply connected to one of the largest and most fragile asset classes in the modern economy: commercial real estate. To understand why office attendance became such a battleground, you have to understand how office buildings are valued, financed, and embedded in financial and political systems. Because once remote work threatened those valuations, a wide range of institutions suddenly had a shared interest in repopulating office space. Let's start with the building itself. An office tower is not just a place where people work, it is a financial instrument. Its value is based on expected rental income, discounted by market assumptions about risk and growth. When tenants sign long-term leases at high rents, the building's net operating income rises. When that income looks stable, the building's valuation rises. And when valuations rise, owners can borrow more against the property. This means occupancy is not only about usage, it's about cash flow predictability. Empty desks threaten more than aesthetics. They threaten the income stream that supports billions in loans. Now consider what happened when remote work became widespread. Suddenly, companies realized they could operate with less physical space. Some downsized, others delayed renewals, some negotiated lower rents. Vacancy rates rose, and as leases rolled over, the gap between old, high-pandemic rents and new, weaker demand started to show up in financial statements. For property owners, this is not a small issue. Commercial real estate is heavily debt-financed. Loans are often structured around assumptions of stable occupancy and rising rents. When income falls, debt service becomes harder. When appraised values fall, refinancing becomes more difficult. A building that looked healthy under one set of assumptions can look distressed under another. This is where institutional incentives begin to align. Office buildings are not owned in isolation. They are held by real estate investment trusts, pension funds, insurance companies, private equity firms, and institutional investors. Banks hold the loans. Municipal governments depend on property taxes tied to those valuations. Entire downtown ecosystems, restaurants, transit systems, retail corridors depend on commuter foot traffic. So when office demand drops, the impact ripples outward. Lower occupancy can lead to lower property values. Lower property values can reduce tax assessments. Lower tax revenue pressures city budgets. Banks with large commercial real estate exposure face rising risk. Pension funds holding real estate assets face valuation losses. None of these actors have direct authority over corporate workplace policy, but they all have indirect influence through political, financial, and social channels. Now look at the corporation deciding whether to mandate a return to office. On the surface, it's a management decision, but corporations are not isolated actors. They are embedded in the same financial system. Their executives sit on boards, their firms borrow from the same banks, their pension obligations are invested in the same funds that hold real estate. Their headquarters often anchor downtown districts where local governments are desperate to restore economic activity. This creates a subtle but powerful alignment. Returning workers to the office supports not only internal management goals, but also the broader asset ecosystem in which the firm operates. In institutional economics, this is called a networked incentive structure. No single actor needs to conspire. Each one responds rationally to their own pressures. But the outcome, a broad push toward repopulating offices, becomes collectively reinforced. Now let's talk about the narrative layer. Publicly, the return to office conversation is framed around collaboration, innovation, and company culture. These factors are real, but they are also convenient. They provide a socially acceptable justification for a policy that also stabilizes property values, protects bank balance sheets, and supports municipal tax bases. Notice what is rarely discussed: the financial exposure tied to empty buildings. If a major tenant vacates, it doesn't just leave space empty. It can trigger loan covenants, lower appraisals, and reduce refinancing options. In extreme cases, it can push properties toward distressed sales. That reprices the entire market downward. Lenders and investors, seeing the shift, tighten credit. New projects stall. Construction jobs decline. The feedback loop extends into the broader economy. Remote work, in this sense, was not just a labor trend. It was a shock to a financial system built on assumptions of physical occupancy. That is why the pressure to return has been strongest in sectors and cities most tied to office-heavy real estate. Financial centers, government districts, and dense urban cores feel the fiscal and financial strain most acutely. In these places, public officials openly advocate for office returns, not only for productivity but for downtown survival. Transit agencies are another piece of this system. Fare revenue depends on commuter flows. Reduced ridership leads to budget gaps, service cuts, or higher subsidies. Those costs fall back on local governments already facing property tax shortfalls. Restaurants and service businesses around office corridors depend on lunch traffic and after-work spending. Their closures reduce employment, sales tax revenue, and urban vibrancy. These effects are visible and politically salient. Office vacancy becomes not just a corporate issue, but a civic crisis. So the return to office debate sits at the intersection of labor economics and asset preservation. For employees, remote work can mean flexibility, reduced commuting costs, and better work-life balance. For employers, it can mean lower real estate expenses and access to broader talent pools. But for the institutions holding commercial property risk, it represents a devaluation event. This creates tension between individual efficiency and institutional stability. From a pure productivity standpoint, many jobs can be done remotely. From a system stability standpoint, a rapid and permanent reduction in office demand threatens a large, debt-laden asset class embedded in public and private balance sheets. Institutional systems tend to resist sudden repricing. When a change threatens to reveal that assets are worth less than assumed, the system searches for ways to preserve the old equilibrium. Encouraging office attendance is one such mechanism. It supports the narrative that demand will return, that leases will be renewed, that values are temporary dips rather than structural declines. The question is whether this is a temporary adjustment or a long-term reconfiguration. If hybrid work becomes the norm, office demand may stabilize at lower levels. Some buildings may be repurposed, others may default. Banks and investors may absorb losses over time. Cities may rezone downtowns toward residential or mixed use. The system adapts, but slowly and unevenly. But institutions often prefer gradualism to sudden recognition of loss. A full, rapid repricing of office real estate would force painful balance sheet adjustments across multiple sectors. By encouraging a return to office, institutions effectively buy time, hoping that occupancy rebounds enough to support refinancing cycles and soften the blow. This is why the return to office conversation feels bigger than corporate culture. It is tied to the preservation of a financial architecture built around office occupancy. None of this means that every RTO mandate is purely about real estate. Managers have genuine beliefs about collaboration. Some work is easier in person, but at the system level, the alignment of financial, political, and civic incentives creates a strong tailwind pushing in the same direction. When you hear calls to revitalize downtown, restore normalcy, or bring back workplace culture, you are also hearing a defense of an asset class. Office buildings are long-lived structures financed with long-term debt. Remote work was a fast-moving change, hitting a slow-moving system. The tension between those timelines is still playing out. The deeper question is not whether workers prefer home or office. It is how quickly institutions can absorb a structural change in space usage without triggering broader financial instability. The return to office mandate, seen through this lens, is not just a human resources policy. It is an institutional response to protect balance sheets, tax bases, and financial stability in the face of a demand shock. And that is why the debate feels so persistent, so charged, and so resistant to simple productivity data. Because behind the discussion about meetings and morale sits a much larger system trying to keep one of its foundational asset classes from repricing too quickly. In the end, the office is not just a workplace, it is collateral. And the fight over returning to it is, in part, a fight over what that collateral is really worth.